In 1637, a single flower bulb cost more than a house. In 2000, a company with no profits was worth more than General Motors. In 2021, a digital coin of nothing hit $69,000. Different centuries, different assets, but if you draw the price chart, they are the same picture every single time. And there is one chart that tells you whether today's AI boom is the year 2000 all over again. Almost nobody draws it. Today we will. Chapter 1. The Anatomy of a Bubble. Before we look at any single bubble, you need to see the shape. Because once you see it, you cannot unsee it. Every financial bubble in history, going back 400 years, traces the same 5 steps. Step 1. Displacement. Something genuinely new appears. A flower, the internet, a blockchain, and a few smart people get in early. Step 2. The boom. Prices rise, the story spreads, more money arrives. Step 3. Euphoria. This is where it breaks from reality. People stop asking what something is worth and start asking only how high it will go. Your barber gives you stock tips. Step 4. The peak. The last buyer buys. There is no one left to sell to. And step 5. The crash. Faster, always faster than the climb. The economist Hyman Minsky mapped this decades ago, and Charles Kindleberger showed it repeats across every market and every era. So the chart you are about to see 5 times is really one chart. Let's start where it all began, with a flower. Chapter 2. .com. We'll skip past the tulips quickly because the first true modern bubble looks shockingly like today. In the late 1990s, the internet was real, transformative, and obviously the future, which is exactly what made it dangerous. Investors stopped pricing companies on profits and started pricing them on clicks. Any business with .com in its name doubled overnight. The poster child was Cisco, trading at 472 times its earnings, a price that assumed it would own the planet. And the index that held all of it, the Nasdaq, went vertical. It hit 5,048 on March 10, 2000. Then step 5 arrived. Over the next 2.5 years, the Nasdaq fell 77%. $5 trillion of wealth simply evaporated. And here is the part people forget. It took 15 years until 2015 just to get back to that peak. The internet did change everything. The stock still crashed. Both were true. So if real, world-changing technology doesn't protect you, what does a bubble in something physical look like? Chapter 3. Houses. Because the next one wasn't about a speculative gadget. It was about the safest asset Americans believed in, their homes. For decades, the rule was simple. House prices only go up. So banks lent to anyone, packaged the loans into securities rated perfectly safe, and the whole world bought them. From 2000 to 2006, US home prices nearly doubled. The euphoria step had arrived dressed as common sense. Then the last buyer bought. From the 2006 peak, national home prices fell 27%, and in the hottest markets, Phoenix and Las Vegas, more than 50%. Because this asset sat at the center of the global banking system, the crash didn't stay in housing. It became the worst financial crisis since the Great Depression. Notice the pattern holding. The more obviously safe the asset feels at the top, the more dangerous it actually is. Which brings us to the most modern bubble of all, one built on something with no earnings, no house, no factory. Pure belief. Chapter 4. Crypto. Cryptocurrency took the bubble formula and ran it at 10 times the speed. Displacement, a genuinely new technology, the blockchain. Boom, prices climbing faster than anything in market history. Euphoria. Your barber wasn't just giving you stock tips now. He was giving you coin tips and quitting his job to trade them. Bitcoin hit $69,000 in November 2021. Around it, an entire universe of tokens, exchanges, and stablecoins inflated to trillions. Then, step 5. Bitcoin fell 78%. The Terra Luna coin went from $40 billion to zero in a week. The exchange FTX, valued at $32 billion, collapsed into bankruptcy and fraud. more than $2 trillion gone. And yet, Bitcoin recovered in about 2 years. Just like the internet, the technology outlived the mania, which is the exact trap. Because the scariest part of a bubble isn't the crash, it's how completely normal it feels at the top. So what does the top feel like right now? Chapter 5, the one we're in. Which brings us to today and the most expensive question in finance. Is artificial intelligence step 2 or step 4? Here is the case that it's a bubble. The top 5 companies in the S&P 500 now make up about 30% of the entire index, the most concentrated the market has been in 50 years. The big AI spenders are pouring up to $700 billion a year into data centers. And Nvidia alone is worth around $4.5 trillion. But, and this is the chart almost nobody draws, here is the case that it's different. At the dot-com peak, Cisco traded at 472 times earnings. Nvidia trades around 45. The Magnificent Seven trade at 28 times forward earnings. The top stocks in 1999 traded at 66. These companies have real revenue, real profits, and they're funding the boom with actual cash. The mania is real. The earnings are also real. That has never been true at the same time before. So which step are we on? Here's the honest answer. The one number that screams bubble is concentration and price. The CAPE ratio today sits near 40, a level only ever beaten at the very peak of the dot-com mania. The one number that says this time is different is earnings. Today's giants actually make money. Every bubble in history had the first. Almost none had the second. So this may not be the year 2000. But 400 years of charts carry one unbreakable lesson. The moment everyone agrees it's different this time is precisely step 4. Watch the shape, not the story. If this gave you a lens you'll never lose, subscribe. We break down one big market idea every week. Next up, the CAPE ratio explained. The single chart Warren Buffett checks before he buys anything.